Exploring the world of tax optimization and financial strategy can be both intriguing and empowering. Taxes for many are a source of frustration and annoyance, but they need not be a financial burden. In this video, we'll embark on a quest to uncover 10 powerful and legitimate strategies to potentially reduce your tax obligations. These strategies are not about evasion, but rather about intelligent financial planning and utilizing the legal avenues available to minimize your tax footprint. So let's dive into the world of tax efficiency and discover how you can keep more of your hard-earned money while building a path to long-term financial prosperity. Here are 10 strategies that could help you reduce your taxes legally. Strategy 1. Develop your business insight by using your entrepreneurship to gain tax benefits. Entrepreneurship is a powerful instrument for lowering tax obligations, as well as for pursuing aspirations and achieving financial independence. Businesses have access to a wealth of benefits inside the maze of tax rules and regulations, namely tax write-offs, deductions, and credits. Some of the richest people in the world are astute and have taken use of the power of entrepreneurship to not only build their financial empires, but also to subtly lower their taxable income. Imagine for a minute if almost every investment you make as a business may be written off. This amusing realization, which Drake playfully encapsulates, emphasizes the fundamental idea. Starting a company that is in line with your hobbies and passions paves the way for you to take advantage of the tax system. While starting a company may seem intimidating, it's important to understand that the business landscape is immensely broad and can accommodate a wide variety of talents, hobbies, and sources of income. The secret is matching your endeavors with your abilities and hobbies, whether you're starting a digital firm, providing consultancy services, or selling handmade crafts. As you start your business path, a number of tax advantages become available to you. Your taxable income may be reduced by deducting business expenses, including operating costs, marketing expenditures, and even a part of your home office. Additionally, many sectors of the economy and geographical areas have tax benefits and credits that may further lower your tax liability. Additionally, knowing how to organize your company, such as creating an LLC or S corporation, may provide you important tax benefits and legal protections. Recognizing that entrepreneurship is a strategic financial instrument rather than merely a means to a goal is essential to developing into a business genius. You may both achieve your personal and professional goals and more adeptly traverse the complicated world of taxes by looking into business possibilities that align with your abilities and interests. This will help to ensure your long-term financial success and stability. Don't be afraid of the concept of starting your own business, since it could lead to both financial stability and personal joy. Strategy 2. Strategy 2. Invest in securities, leveraging deferred income and smart investments for tax efficiency. Deliberately delaying the acknowledgement of income is a key component of tax evasion, and many financially savvy people, particularly the wealthy, engage in this technique. Rich people know that cash receipts should only be sought when absolutely necessary. Otherwise, they wisely reinvest their gains. Consider a situation where you made a sizable $100,000 profit in a single year to demonstrate this. You decide to reinvest this money instead of keeping it in your pocket right now, possibly by buying some equipment or real estate. This tactical strategy accomplishes two goals at once. It avoids a potentially huge tax payment, while simultaneously fostering an investment with the potential to generate future cash flow. The key to this tax-saving strategy is that reinvested gains are not regarded as taxable income. You are also sowing the seeds for future financial success by investing your income in profitable ventures. It's crucial to understand that everyone has different requirements and goals, and that everyone's financial situation is different. However, you should take into account the significant influence that taxes might have when deciding on your remuneration and creating a budget for your company. Tax preparation may result in considerable swings, sometimes as high as 50%, depending on your income level, and these savings can greatly improve your long-term financial situation. Strategy 3. Relocation. Harnessing the power of geographical tax optimization. In terms of tax optimization, where you live may have a major impact on how much money you make. The attractive tactic of migration, which may substantially reduce or perhaps completely eliminate your income tax bill, is encouraged. Some nations are recognized for their alluring allure. They levy zero income taxes. Examples include Dubai and the Bahamas. You have access to a vast array of tax benefits by making one of these tax havens your main abode. For individuals looking to make the most of their financial resources, the idea of living tax-free may be quite alluring. Don't worry if the idea of changing citizenship seems to be too difficult a step. There are options closer to home. Numerous states in the U.S. have very advantageous tax perks, thus serving as domestic tax havens. Several places like Puerto Rico, Florida, and Texas have developed a reputation for being tax-friendly vacation spots. You may be able to significantly reduce your total tax burden by moving to one of these states. The strategic potential of regional tax optimization is essentially highlighted by this strategy. You may uncover significant savings and establish a financial environment that is in line with your aims by selecting your house with tax efficiency in mind. Your choice of location, whether you choose foreign tax havens or local tax-friendly states, may have a significant influence on your financial well-being by giving you the chance to reduce your income tax and keep more of your hard-earned money. Strategy 4. Make charitable donations to increase your impact and lower your tax obligations. Giving, or the act of charity, has the rare ability to both create a great influence on the world and provide a powerful means of decreasing your tax burden. This strategy urges you to go into the realm of charity, where your spirit of giving may coexist with clever tax strategy. This advice is based on the basic idea that gifts made to charities are not regarded as taxable income. Many wealthy people who are committed to philanthropy do so because of this potent idea. You've probably seen the substantial gifts made by the rich to their own foundations, or those of others, which serve both as smart financial maneuvers in addition to supporting social and humanitarian objectives. The creation and administration of your charitable foundation is one strategy that is really useful. You may give assets other than money when you establish and manage your charity. Your taxable income is effectively reduced when you donate land, cars, or other valuable goods, since you are now eligible for charitable deductions. Strategy 5. Make the most of your retirement accounts to secure your future and reduce taxes. A crucial financial objective is saving for retirement, and it's also a wise move to lower your tax obligations. Strategy 5. Make the most of your retirement accounts to secure your future and reduce taxes. A crucial financial objective is saving for retirement, and it's also a wise move to lower your tax obligations. Strategy 5 stresses the value of using retirement funds to their greatest potential, not only as a way to ensure financial stability in your later years, but also as a powerful instrument for maximizing your tax status. The idea of delaying taxes is the core of this advice. You simply delay the taxation of your income by making contributions to retirement accounts, like a Roth IRA or a 401(k). The tax advantages of this deferral are immediate, and it also provides a safety net for your retirement years. These retirement accounts come with a number of benefits. First of all, you may be eligible to deduct your contributions from your taxes, which would reduce your taxable income for the current year. Second, when your assets increase in value over time, you won't pay capital gains or dividend taxes, since the growth of your investments inside these accounts is tax-deferred. Furthermore, depending on the kind of account and your age, these accounts often have contribution limits. You may get the most out of this tax-effective method by being aware of and making the most of these limitations. Strategy 6. Take equity rather than cash to strategically accumulate wealth while minimizing taxes. Understanding the art of compensation is one of the fundamental ideas in the pursuit of financial knowledge. This strategy dives further into this idea by promoting the tactic of choosing equity over upfront cash payments, a decision that may result in significant financial benefits and tax savings. This advice's fundamental ideas are asset ownership and delayed income recognition. When feasible, wealthy people, particularly successful business people and seasoned investors, want to be compensated in the form of stock rather than cash. This tactical decision has various benefits. First of all, it ties your financial goals to the long-term prosperity of the company you work for. When you own stock in a firm, you become a shareholder with a financial stake in its success. This may inspire you to put out your best effort to guarantee the company's success, which might eventually result in more money. Second, gaining equity comes with clear tax benefits. Equity compensation may often be postponed, which lowers your current tax obligation. Immediate cash payments are taxed in the year they are received. By deferring recognition of income, you may put off doing so until a later time when it could be more tax beneficial to do so, or when you've carefully prepared for it. Furthermore, equity compensation may make it possible to implement further tax-saving measures. For instance, you could profit from capital gains tax rates when you ultimately sell the shares, if its value rises over time. When compared to standard income tax rates, this may lead to large tax savings. Strategy 7. Earn passive income by making smart investments to foster financial resilience. This strategy encourages you to investigate the idea of creating passive income, a course of action that not only strengthens your financial fortitude but also provides tactical tax management benefits. The term passive income refers to revenues that come to you with little to no active work on your side. It is often referred to as mailbox money. This income source might be especially helpful since it offers monetary stability, acts as a safety net against unforeseen financial difficulties. The core of this advice is the notion that people who have collected assets that produce income on their own may enjoy the luxury of passive income. Rental properties, dividend-paying stocks, interest-bearing investments, or a successful company that can be run with little day-to-day participation are a few examples of such assets. From a tax viewpoint, passive income provides many important benefits. First and foremost, it's often taxed at a lower rate than regular earned income, which may save you a lot of money in taxes. Additionally, passive losses like depreciation on rental properties or costs tied to your investments operation may sometimes be used to offset passive income. This may further lower your total tax obligation. A measure of stability may also be offered during economic downturns by the diverse nature of passive income sources, which give a steady cash flow independent of active work. Strategy 8. The art of tax optimization. Through strategic asset management, leverage passive losses. In terms of tax efficiency, tip #8 explores the complex technique of leveraging passive losses, a potent financial approach that not only reduces your present tax liabilities but also maximizes your long-term wealth-building efforts. This tip's fundamental tenet is the understanding that investments in certain assets, especially ones that normally increase in value over time, often provide possibilities to produce passive losses. These losses may be useful instruments for decreasing your taxable income, which will eventually reduce your tax burden. Let's examine this tactics operation in more detail. Let's say you are the owner of an investment property, such a rental home. The property's worth could increase over time, which might result in a financial gain when you ultimately decide to sell it. But in the meanwhile, you may also deduct property depreciation as a passive loss. Despite not being a real financial transaction, this depreciation charge is recorded as a loss on your tax return, which reduces your taxable income. In their capacity to reduce passive income, passive losses are beautiful. The passive losses from your property may balance out any passive income you may have from other assets, such as dividends from stocks or interest from bonds. This implies that you may be able to save money on taxes by substantially reducing the amount of your total income that is taxable. Furthermore, you may be allowed to carry forward those losses to offset future passive income. If your passive losses in a particular year are greater than your passive income, this has the benefit of tax loss harvesting, which enables you to tactically spread out your tax responsibilities across many years. Strategy 9. We go into a complicated financial plan that focuses on selecting loans over cash payments right away, a decision that both unlocks financial power and opens up tax efficiency prospects. This advice is fundamentally based on the idea of protecting your money and reducing your tax obligations. Many people, especially the financially savvy, use this technique to carefully manage their cash flow and tax responsibilities. Imagine yourself in a situation where you need money right now to cover a cost. You decide to take out a loan, as opposed to using up all of your financial reserves. The main difference is that loans are not regarded as taxable income in this case. Receiving a loan is effectively taking on debt that you have to pay back. As a result, it is not considered to be taxable income, offering immediate tax benefits. Additionally, there are several methods to arrange loans to maximize tax advantages. For instance, if you operate a company, you may be able to deduct the interest you pay on loans you take out for that reason. This implies that the interest you pay on the loan may be deducted from your income as an expenditure. Additionally, loans provide you a special degree of financial freedom. By using loans, you may keep your investment portfolio intact while taking care of your urgent financial requirements. This avoids the need to liquidate investments or assets to obtain cash, which might result in taxable events. Strategy 10. The fascinating tactic of purchasing art. It not only enhances your investment portfolio, but also has clear tax efficiency benefits. This advice's main focus is the distinctive characteristics of the art market. The last significant uncontrolled market in the world, art is sometimes regarded as a tempting area for strategic investment. The beauty of this strategy is that it has the ability to not only diversify your assets, but also with careful preparation, reduce your tax liabilities. Here's how it works. Assume you got $500,000 and decide to spend the full amount in a unique artwork with a $500,000 market value. The tax deduction for your investment matches your income, which is one of its beauties. Therefore,